I was sitting across from a financial advisor last week, a well-credentialed professional at a major firm, when he said something that made my blood run cold. Mr. Marks, he told his client, a 62-year-old woman who'd worked her entire life as a teacher, at your age, you need to be conservative. We're going to put 70% of your portfolio in bonds and keep the rest in dividend stocks. Safety first. The client nodded, relieved. It sounded so reasonable, so prudent, so safe. I wanted to interrupt. I wanted to explain why that advice, delivered with such confidence and wrapped in the language of caution, could be one of the most dangerous things she'd ever hear about her money. But I wasn't part of that conversation. I was simply overhearing it in a coffee shop. And as I watched that advisor collect his fee for delivering conventional wisdom, I realized how many people over 50 are receiving this same advice right now in 2025, without understanding what it really means for their financial future. So let me tell you what I wish I could have told that teacher. Because if you're over 50, there's a phrase financial advisors love to use that should immediately raise red flags. And understanding why might be the difference between a comfortable retirement and running out of money when you need it most. I'm Howard Marks. I've been managing money since 1969. I've seen every market cycle, every crisis, every period of euphoria and panic over the past 5 decades. I co-founded Oaktree Capital Management, where we manage over $170 billion in assets. Warren Buffett has said he reads my investment memos first when they arrive, and I'm telling you, the conventional wisdom about investing after 50 is not just wrong, it's potentially devastating. The phrase you need to watch out for? Act your age. When a financial advisor tells you to act your age with your investments, what they're really saying is this: as you get older, you should automatically become more conservative. They'll recommend formulas like subtract your age from 100 to determine your stock allocation. If you're 60, you should have 40% in stocks. If you're 70, just 30%. The rest? Bonds and cash. Safe assets. It sounds logical. It feels prudent. And for decades, it was considered gospel in the financial planning industry. There's only one problem. It's based on assumptions about the world that no longer exist. Let me explain what I mean by walking you through what's actually happening when advisors give this advice, why it made sense once upon a time, and why following it today could be the biggest financial mistake of your life. The logic behind Act Your Age investing goes like this. As you approach retirement, you have less time to recover from market downturns. Therefore, you should reduce your exposure to volatile assets like stocks and increase your holdings of stable assets like bonds. When you're 30, you can afford to ride out a market crash because you have 35 years until retirement. When you're 65, you can't take that risk. On the surface, this makes sense. I've even seen it work for some investors during certain periods of history. But here's what that advice is really telling you to do, stripped of its comforting language. It's telling you to guarantee that your purchasing power will decline over time. Think about what bonds actually are. When you buy a bond, you're lending money to a government or corporation in exchange for a fixed stream of interest payments. If you buy a 10-year Treasury bond today in early 2025, you're locking in a rate of around 4.5%. That sounds reasonable until you consider what it means in practice. Inflation over the past 3 years has averaged over 4% annually. Even if it moderates, and let's say it settles at 3% going forward, your safe 4.5% bond is giving you a real return of 1.5% before taxes. After taxes, if you're in a 25% bracket, your real return is barely positive. You're treading water at best. Now, extend that out over 20 or 30 years, because here's the thing nobody wants to talk about. If you're 60 years old today, you're not investing for 5 years, you're investing for 30 years or more. Life expectancy has changed dramatically. A healthy 65-year-old today has a decent chance of living into their 90s. If you're married, there's a strong probability that one of you will live past 95. That means your portfolio needs to support you not for a decade, but for 3 decades or more. And this is where the Act Your Age advice becomes truly dangerous. If you follow it, you're putting the majority of your money into assets that will, at best, keep pace with inflation. Meanwhile, your expenses, healthcare, housing, food, everything, will continue rising. Every year, your purchasing power erodes a little more. By the time you're 80, the income that felt adequate at 65 doesn't cover your needs anymore. I've watched this happen. I've seen retirees who followed all the conventional wisdom, who were prudent and conservative, slowly realize that their safe portfolio isn't safe at all. It's a slow-motion disaster. But here's what really troubles me. This advice isn't just outdated. It's often given for the wrong reasons. Financial advisors operate in a world of liability. They're terrified of being sued. If they put you in stocks and the market crashes, you might blame them. You might sue. You might leave a bad review. But if they put you in bonds and you slowly run out of money 20 years later, that's not their problem. You're not going to sue them for following industry standard advice. You're just going to be broke. So they optimize for their own risk, not yours. They give you the advice that protects them, wrapped in language about protecting you. Now, before I go further, let me be clear about what I'm not saying. I'm not suggesting that everyone over 50 should have 100% of their money in stocks. I'm not advocating recklessness. What I'm saying is that the automatic formulaic approach to asset allocation based solely on age is fundamentally flawed. It ignores the most important factors: your actual situation, your needs, your timeline, and the economic environment we're living in. Let me share how I think about this differently. First, I start with the question that matters. What is this money for? Not, how old am I? But, what do I need this money to do? If you're 60 and you need income in 5 years, then yes, the money you'll need in 5 years should be in relatively safe liquid assets. But the money you won't need for 20 years, that money has a 20-year time horizon. It should be invested accordingly. This is called bucketing, and it's how sophisticated investors actually think about their portfolios. You have buckets for different time horizons. Your near-term bucket, money you'll need in the next 5 years, can be conservative: bonds, stable dividend stocks, cash equivalents. But your intermediate bucket, money for years 5 through 15, can take more risk. And your long-term bucket, money for years 15 and beyond, should be positioned for growth. Why? Because that long-term money isn't really for you at 60, it's for you at 80. And the you at 80 is going to need that money to have grown to keep pace with 3 decades of inflation and rising expenses. Second, I think about what kind of risks I'm actually taking. The financial industry has trained us to think that stocks are risky and bonds are safe. But that's only true if you define risk as short-term volatility. There are other kinds of risk. There's inflation risk, the risk that your purchasing power will erode. There's longevity risk, the risk that you'll outlive your money. There's sequence of returns risk, the risk that a market crash early in retirement will permanently damage your portfolio's ability to recover. When you're over 50, inflation risk and longevity risk are often bigger threats than market volatility. A portfolio that's safe in the conventional sense, heavy on bonds and cash, is actually quite risky when you consider these other dimensions. I learned this lesson watching what happened to retirees in the 1970s. They'd done everything right according to the conventional wisdom of the time. They'd moved into bonds and safe investments. Then inflation hit. Their fixed income stayed fixed while prices doubled. They went from comfortable to struggling, not because they took too much risk, but because they took the wrong kind of risk. We're seeing echoes of that today. The inflation surge of 2021 to 2023 caught many retirees off guard. Those who'd followed the act your age advice and moved heavily into bonds saw their purchasing power erode rapidly. Those who'd maintained exposure to stocks, which can at least partially keep pace with inflation over time, fared better. Third, I think about the difference between needing to be right and needing to not be wrong. This is subtle but crucial. When you're young, you can afford to take big swings. You can put money into speculative investments because if they don't work out, you have time to recover. You need to be right on some of your bets to build wealth. When you're older, the calculus changes. You can't afford catastrophic losses. But, and this is the key point, you also can't afford to be so conservative that you guarantee a slow decline. You need a portfolio that won't blow up, but that also has a reasonable chance of growing faster than inflation. This is why I think about risk management differently than most advisors. I'm not trying to eliminate all volatility. I'm trying to eliminate the risk of permanent capital loss while maintaining exposure to assets that can grow over time. How do you do that? Diversification, yes. But intelligent diversification, not the kind where you own a little bit of everything and end up with a mediocre portfolio that does nothing particularly well. I want exposure to businesses that can raise prices with inflation. I want companies with pricing power, strong competitive positions, and the ability to grow earnings over time. I want some exposure to real assets, things like real estate or commodities that tend to hold value when inflation rises. And yes, I want some bonds, but not as the majority of my portfolio. They're there for stability and liquidity, not as my primary return generator. Fourth, I think about the difference between income and total return. This is where a lot of advisors lead their clients astray. They'll say, you need income in retirement, so let's build you an income-focused portfolio. We'll buy bonds and dividend stocks that pay you regular cash. It sounds sensible, but it's often the wrong approach. Here's why. There's no meaningful difference between receiving a 4% dividend and selling 4% of your appreciated stocks. Both put cash in your pocket, but the dividend-focused approach often forces you into lower quality investments that happen to pay high dividends, while the total return approach lets you own the best businesses regardless of their dividend policy. Some of the best companies in the world, companies I'd want to own for the long term, pay minimal or no dividends. They reinvest their earnings to grow the business, which ultimately creates more value for shareholders. If I need cash, I can sell a small portion of my shares. The end result is the same, but my portfolio is positioned for better long-term growth. The obsession with income is a mental accounting trap. What matters is total return, the combination of dividends, interest, and capital appreciation, not how that return is divided between income and growth. Now let me address what you're probably thinking. But Howard, what about sequence of returns risk? What if I retire right before a market crash and have to sell stocks at depressed prices to fund my living expenses? This is a legitimate concern. It's the nightmare scenario for retirees. You retire in 2007 with a stock-heavy portfolio, the market crashes in 2008, and you're forced to sell at the bottom to pay your bills. Your portfolio never recovers because you've locked in those losses. This is real. This happened to people. And it's why having some conservative assets makes sense. But here's what the act your age advisors get wrong. The solution isn't to avoid stocks entirely. The solution is to have enough safe assets to weather a downturn without being forced to sell stocks at the wrong time. This is where the bucketing approach I mentioned earlier becomes crucial. If you have 5 years of living expenses in bonds and cash, you can ride out most market downturns without touching your stock portfolio. The market crashes, but you're not a forced seller. You live off your safe bucket while your stock bucket recovers. By the time you need to tap into your stocks, they've rebounded. This approach gives you the best of both worlds: protection against sequence of returns risk and the growth potential of equities for your long-term needs. I've been using variations of this strategy for decades, both for Oaktree's portfolios and in my own personal investing. It's not perfect, nothing is, but it's far more robust than the simplistic act your age formula. Let me give you a concrete example of how this plays out. Imagine two 65-year-old retirees, both with $1 million portfolios, both needing $40,000 per year to supplement their Social Security. Retiree A follows conventional advice. She puts 70% in bonds and 30% in stocks. Over the next 20 years, her bonds return an average of 4% and her stocks return 8%. Her blended return is about 5.2% before inflation. After inflation of 3%, her real return is 2.2%. She withdraws $40,000 per year, adjusted for inflation. By age 85, her portfolio is worth about $850,000 in today's dollars. She's okay, but her purchasing power has declined, and she's increasingly worried about running out of money. Retiree B takes a different approach. She keeps 5 years of expenses, $200,000, in bonds and cash. The remaining $800,000 goes into a diversified portfolio of stocks. Her stocks return 8% over 20 years. She lives off her safe bucket for the first 5 years while her stocks grow. Then she periodically replenishes her safe bucket by selling some stocks. By age 85, even after withdrawing $40,000 per year adjusted for inflation, her portfolio is worth about $1.4 million in today's dollars. She has more money than she started with, and she's not worried about running out. The difference? Retiree B maintained exposure to growth assets while still protecting herself against sequence of returns risk. Retiree A followed the conventional wisdom and paid the price in lost purchasing power. Now, I can already hear the objections. But what if there's a crash? What if the market doesn't recover as quickly? What if stocks don't return 8% over the next 20 years? These are fair questions, and they get to the heart of why investing is hard. We don't know what will happen. I've said many times that I don't know where the market is going. Nobody does. Anyone who tells you they do is either lying or deluded. But here's what I do know. Over long periods, stocks have consistently outperformed bonds. Not every year, not every decade, but over 20 to 30-year periods, the evidence is overwhelming. And if you're 60 today and might live to 90, you have a 30-year time horizon. Could stocks underperform over the next 30 years? Yes. Could we enter a prolonged period of low returns? Absolutely. But if that happens, if stocks fail to deliver meaningful real returns over 3 decades, then we have bigger problems. It would mean something fundamental has broken in the economic system. And in that scenario, your bond-heavy portfolio won't save you either. I'd rather position myself for the most likely scenario, that capitalism continues to work, that businesses continue to create value, that stocks continue to provide positive real returns over time, while protecting against the downside through intelligent portfolio construction. This brings me to another critical point that advisors often miss. Not all stocks are created equal. When I talk about maintaining equity exposure in your 60s and 70s, I'm not suggesting you buy speculative tech stocks or cryptocurrency or whatever the hot investment of the moment is. I'm talking about owning high-quality businesses with sustainable competitive advantages, strong balance sheets, and the ability to generate cash flow through various economic environments. Companies that have been around for decades and will likely be around for decades more. Businesses that provide essential products and services that have pricing power that can grow modestly but consistently over time. This is boring investing. It's not exciting. You won't get rich quick, but you also won't blow up. And over 20 to 30 years, these businesses will likely deliver the returns you need to maintain your purchasing power and then some. The financial industry doesn't like this approach because it's not complex enough. They can't charge high fees for it. They can't justify their existence by telling you to buy index funds of quality companies and hold them. So instead, they create elaborate strategies, they rebalance constantly, they chase performance, and they charge fees that eat into your returns. I've watched this game for 50 years. The advisors who add the most value aren't the ones with the fanciest strategies. They're the ones who keep their clients from making emotional mistakes, who provide perspective during market turmoil, and who construct portfolios aligned with their clients' actual needs rather than industry formulas. Unfortunately, those advisors are rare. Most are following scripts written by compliance departments designed to minimize the firm's liability rather than maximize the client's outcomes. So what should you do if you're over 50 and your advisor is telling you to act your age? Ask questions, lots of them. Ask them to explain exactly why they're recommending a particular asset allocation, not because you're 65, but the actual reasoning. What assumptions are they making about returns, about inflation, about your life expectancy, about your spending needs? Ask them about the different types of risk. How is their recommendation addressing inflation risk, longevity risk, sequence of returns risk? If they only talk about market volatility, they're missing the bigger picture. Ask them to show you projections. What happens to your portfolio over 20 years under their recommendation? What if inflation is higher than expected? What if you live longer than the average life expectancy? Run the numbers. See if their safe approach is actually safe for your real situation. Ask them about their compensation. How are they paid? Do they earn commissions on the products they recommend? Are they incentivized to put you in certain investments? This doesn't mean they're bad people, but it helps you understand potential conflicts of interest. And here's the question I think is most important. Ask them what they would do if this were their money, not what the models say, not what the firm recommends. What would they actually do if they were in your shoes? You might be surprised by the answer. I've had conversations with advisors who privately admit they think their firm's standard recommendations are too conservative, but they're required to follow certain guidelines. If you can get them to be honest, you might have a very different conversation. Of course, not everyone needs a financial advisor at all. If you're comfortable making your own decisions, if you have the time and inclination to manage your own portfolio, you might be better off doing it yourself. The fees you save can be substantial over time. A 1% annual advisory fee doesn't sound like much, but over 30 years, it can cost you hundreds of thousands of dollars. But if you do work with an advisor, make sure they're actually adding value. They should be helping you think clearly about your situation, providing expertise you don't have, and keeping you from making emotional mistakes. If all they're doing is implementing a standard age-based formula and charging you for the privilege, you're not getting your money's worth. I want to close with a personal observation. I'm in my late 70s now. According to the conventional wisdom, I should have almost all my money in bonds. I should be playing it safe, preserving capital, avoiding risk. I don't. I maintain significant exposure to equities, not because I'm reckless or because I think I'm smarter than everyone else, but because I understand my actual situation. I have a long time horizon. I plan to live a long time and I want to leave something for my family. I understand that inflation is a bigger threat to my purchasing power than market volatility, and I've structured my portfolio to withstand downturns without forcing me to sell at the wrong time. Does this mean I'm right and everyone else is wrong? Number. It means I'm making decisions based on my circumstances rather than following a formula based on my age. That's what I want for you. Not to follow my specific approach, but to think critically about your own situation, to question the conventional wisdom, to understand that safe isn't always safe, and that the biggest risk you face might not be the one your advisor is warning you about. When someone tells you to act your age with your investments, what they're really saying is, follow this formula that protects me from liability, regardless of whether it's right for you. Don't accept that. Your financial future is too important to leave to formulas and conventional wisdom. You've worked your entire life to build your savings. You've earned the right to have those savings work for you in the way that makes the most sense for your actual situation. Don't let anyone, no matter how credentialed or confident, tell you otherwise based solely on the number of candles on your birthday cake. That's my perspective after 50 years of watching markets, managing money, and seeing what works and what doesn't. I hope it helps you think differently about the advice you're receiving and the decisions you're making. Because in the end, it's your money, your retirement, and your future. Make sure the decisions you make are based on your needs, not someone else's formula.